All right, welcome back, everybody. Little review of the market here. We're going to be a little quicker with it. We only have our guests for half an hour today. Obviously, things going on. S&P is within sniffing distance of all-time highs, which just goes to show kind of our favorite saying of buy based on what you see, not based on what you think. Makes a lot of sense, given that we've been on the verge of World War III, so oil prices spike, tariffs, potential inflation, and we're still almost at all-time highs. So we'll see where it goes from here. I'm adding. I'm not aggressively adding. I would much rather add on dips, but and who knows whether the ceasefire holds. I I said it in the newsletter this morning. I don't necessarily think war in the Middle East is bearish. And so if the ceasefire doesn't hold and the market sells off, I think I'm buying that. But that's where we are. Jeremy, your thoughts?
Yeah, I was a full-fledged member of the BTFD crew yesterday. I picked up some calls. I'm pretty much balanced now. I did what I did. I kind of realized that Iran didn't seem to have too many teeth left, and going into the end of things, even Russia abandoned ship. So the only support they had was China buying their oil. So yeah, it was a matter of time before this kind of unwound. Whether we dropped the bunker busters or Mossad went in and did it on the ground, the job had to be done, and the market just kind of follows what it does. When you go into chase oil on something like that, look in the background and see what's really going on, and you realize that it probably wouldn't have been worth chasing oil. It's better to just ride the market and do what you do.
All right, so I'm going to introduce our guest. This is Kevin Green from Charles Schwab, KG. For what it's worth, I'm really close with the old CEO of Charles Schwab, Tim McCarthy. What's up, Tim? And I had my biggest all-time trading win ever was being long Schwab calls for about 6 months. I just killed it. Like that was many, many years ago. That was my greatest all-time trade. So anyway, having said that, love Schwab. Kevin, what's up?
Yeah.
Where do you think the markets are going?
Yeah, well, obviously the markets are ripping higher, and if you hear that in the background, I live kind of close to a military air base by Carson down there in the Springs. So they've been doing sorties and things of that nature ever since all of this stuff has been kind of breaking down here. So if you hear that in the background, that's all you hear. But the market for the most part right now doing a phenomenal job. When you're looking at the internal structure, you have the sectors that you really want to see outperform: communication services, information technology, even seeing financials catching a little bit of a bid here as well. So the market breadth is definitely there. You have some geopolitical risk premium being taken off. You have crude oil moving to the downside. Maybe we'll talk about that in a little bit here. And we're really close to all-time highs. We're less than 60 points or so from all-time highs here. So it seems like the market's really kind of set up for that summer lull bull run scenario, barring any type of news flow that actually hits or we see any type of reversal for the ceasefire here. So overall, it's been pretty busy, but the fact that we don't have World War III, I think the market's okay with that, and we'll worry about the tariff policy and Fed policy a little bit later here.
That's kind of what it seems. Kind of seems we're waiting for that shoe, but I don't think we're too worried about it.
No, and it looks like there may be a internal fight brewing in the Fed.
Yeah.
And you got people kind of stepping up, wanting to be the next Fed chair. And and again, I mean, I wouldn't bet against Trump in anything. He wants the Fed to lower interest rates. I think you could see a more dovish Fed outcome than what a lot of people are thinking here, which just kind of adds to the bullish backdrop. There was also there's a guy I follow on Twitter, the umpire. He had a tweet last night that I thought was pretty powerful. He said something along the lines of, it's hard to be a short when the market rallies on war and peace. And yeah, I mean, I would agree. I mean, it's we'll sell off at some point. We always do, but hard to see them knocking this thing down at the moment. unless something comes out of left field.
So KG, you guys have like tons of clients, right? So what do your clients say? Like, you guys must analyze what retail's saying about sentiment and all that, and risk on, risk off, all that. Where are your guys at?
Yeah, so I'm a part of the network, so technically a little bit of a separate entity, but we do have the stacks report, and we continue to see these buyers of the dips in the market. Anytime we have any type of sell-off, you see some buyers really trying to step in, and still getting into those popular names as well. I mean, the ones that have really big cult followings, the Oklos of the world, the Palantirs of the world, what have you, those thematic type of stocks, even though you may love them, you may hate them, they get enough flow on the retail front to really try to push prices higher. Regardless of what valuations are kind of telling you. So that's kind of the interesting thing. And I think the market's just so used to this buy the dip mentality, right? At some point in time, is it going to kind of reverse? Are people going to get burnt? That may happen, but it seems like we've had a heck of a lot of events over the last year that we've been able to deal with pretty easily. Now, I think if you kind of look at that reversal with the tariffs there, it was more of a capitulation, in my opinion, of the administration is really trying to hold that off. That created this rally to the upside. But I think overall, the market continues to try to buy these dips as aggressively as possible. You know, an unfortunate thing that I kind of think about, and I was saying the same thing, kind of what Matt, you were kind of alluding to. No one likes war. No one likes people dying. And I hate saying this, but war type of markets or geopolitical risk type of markets are actually probably one of the easier markets to trade.
Yeah, oh yeah.
Because it's easy. I mean, and when I say that, it's you look at what does everybody really kind of go to? Defense stocks. I mean, they were already pumping kind of right before the event. It was kind of on the horizon. Crude oil was doing the same. You start looking at that backdrop and in the layout, especially with OPEC plus. Like, why would OPEC actually increase their production quotas in an environment like this when prices are so depressed? There's a reason why, right? Everything was kind of had the writing on the wall. You buy crude, you buy commodities when everybody hates them, and then you sell them when everybody loves them. When everybody started saying $80 or $90, $120 oil, $150 oil, and I saw that over the weekend, it was like, hey, you know, like that's a pop and fade, and that's just how it is. And you can, and then you don't sit in the trade for too long. You move forward to the next trade. So it's unfortunate, but I do believe that these type of geopolitical risk events are easier to trade because either you're going to have a protracted event, which is going to spark economic spending here in the United States. You would probably have the Fed actually cut rates and make liquidity a lot more available in any type of wartime environment. Or you have a ceasefire, you take that risk off, and at the end of the day, once that risk kind of melts out, everybody kind of looks at the other events that are going on. And the last thing I want to say too is kind of like you have these stretched events, and this is actually really specific to this administration. Every administration has this, but Donald Trump, he'll stretch you out in a way where a situation that might be bad, we may have another situation that's like 3 times as bad. That 3 times as bad situation gets resolved. And then the thing that we were actually worried about, people are like, oh, this is not that bad anymore, right? No, even if we talk about trade wars and tariffs and things of that nature,
great,
are we really freaking out about what's going to happen over the next 2 weeks? Probably not as much as we were in the past, because we avoided nuclear war. So that's kind of how I also look at this too. He's going to stretch out so you're a little bit more tolerable to maybe some things that you were very uncomfortable with before. Over time, I think the market's going to be able to be okay, even if we do see maybe some tariffs getting re-implemented over the next couple of weeks.
The one interesting thing you mentioned too is oil. I mean, whenever they say, "Oh my God, war in the Middle East, oil's going to 150," that should be an almost automatic short. I mean, the spice must flow. There is no way that us, China, are allowing a disruption in our supply of oil. It's just not going to happen. You know, I shorted the first pop on this, and I was telling Jeremy, unfortunately, I was on the golf course yesterday and couldn't short oil yesterday. But yeah, I mean, that's like one of the easiest trades ever. And I saw so many people on Twitter like, oh my God, you know, I bet against this and this and that, and I'm going to get crushed on my long oil position. It's like, you know, moron.
Yeah. Well, you know what was, I'm sorry, you know what was actually a very interesting trade in that type of environment. If we're in this environment again, kind of look at this, not a recommendation. If you buy crude, now I'm talking about the futures.
Yeah, the
If you
futures
get
were
in a,
lit.
yeah, if you get in this event, like don't look at like Chevron and be like, oh, this is gonna be my proxy. Like there's enough that's out there nowadays for you to get exposure to crude oil one way, shape, or form. It's futures, you can trade the micros, you can trade the micro options, you can trade USO. There's so many different things. But if you know, one of the actually easier trades that you had over the last week and a half or this 12-day war or what have you was actually buying crude at the close, selling it once the overnight session opened up, because all of that pent up uncertainty for that hour push prices up every single time. Look at every single chart that was, even if it was bearish, you still had a bullish pop at that open. That was also another one of those easy trades. And the Suez or not the Suez, the Strait of Hormuz, 20% of the oil flow. Everybody's heard about it. You're right. They're not going to shut it down. It's never been fully closed. Iran tried to shut it down in 1988 and they got stomped in one day. Their naval fleet got completely destroyed in one day. And you start pissing off more of your allies than you have as far as political capital. So when you start hearing that theme as well, it's like, all right, well, are they really going to shut it down? Probably not.
So you're the options guy, I guess, at Schwab. What types of strategies are you liking right now on the option side? And that said, just so you know where we're coming from, I love buying calls, I love selling puts, and I love doing ratios. Jeremy's more of a wheel guy. Where do you fall right now on option strategies?
Yeah, it kind of depends on the environment. So I would say if you're asking me the last 2 weeks, 3 weeks, Matt, ratio spreads for sure. I mean, because you have the ability, just like we are seeing right now, last 2 days, we're up almost maybe close to 2%, give or take. So you could do ratio spreads if you're looking at going long one call, going long two puts. I wouldn't probably do that. I would probably do it the opposite way, right? The bullish or the skew was actually on the put side rather than the call side right now, and just looking for this outsized move that you have, because implied volatility was actually really elevated. Now VIX is coming down to around 17 and a half or so. This gets more into the just buying long calls or buying long puts type of environment, in my opinion, especially if we start trending like this market is trending right now, where it's just kind of melting up. I think that's probably the strategy to do. And you could probably sell some premium in this environment. But for me, once you get to around a 19 VIX, premiums don't look as sexy unless you're really willing to open up their, hold the stock as well, right? If you're willing to sell some downside, because the biggest risk that you have is any type of meaningful reversal in a situation where you have the market in complacency right now, and then something does shock. It creates a domino type of an event. So you got to be willing to hold the stocks if you're selling puts straight outright, in my opinion. Or you can look at selling some put spreads, or even looking at call spreads if you're bearish on the market. But I would say ratio going into more of the long call, long put scalp strategy, in my opinion.
I've been easing a little bit off of some of my wheel strategy holdings and leaning on some spreads, rather just debit spreads in whatever direction I think we're going to trend. So you're right. I mean, once you see that VIX start to fluctuate like that, the premium's just not as glorious. So it's like, well, I can bide my time and wait. My position's not in any trouble. I can idle for a little while and wait for another pop to go and play whack-a-mole with it.
Yeah, I mean, here's the VIX.
Yeah.
So just people understand what we're talking about. I mean, if you're trying to buy calls at the beginning of April, you could have been right, which you would have been. You still may not have made money because of what you were paying for your calls. On the other hand, if you were writing puts, you would have been guaranteed to make money, on those, again, depending on what you're buying them on. And, again, now we're in an environment where we're not, at the yearly lows on VIX, but we're getting pretty close to it. Yeah, so it's, something you want to monitor if you're an options guy. I like to have a mix of short puts, long calls, and then I skew, based on where volatility is.
Yeah. Yeah, I would
So
agree. Especially in a melt up market like this, it's kind of like, if you were doing long SPY 2 weeks out or so, not too bad. But the backwardation, we didn't see any type of formal backwardation, aggressive one as
Right.
well in this whole event. That's also another telltale sign too. So what I look at for the viewers, I look at the spot VIX and I'll subtract that from the front month VIX futures contract to see if there's more implied volatility within the first 30 days than the next, let's say 60 days out. And usually when you have that backwardation, that's the prime environment for selling premium as well. And it was just everybody was on edge and we're hearing about it on TV. But vol wasn't really pricing in anything that was too aggressive as well. In fact, you're actually more to the downside right now when it comes to that backwardation, which means that premiums are relatively cheap. Historical or realized vol could actually thin out here or become a little bit less. And also you could look at downside protection for hedging portfolios is still relatively cheap over the last year.
Yeah, no, and that's typically where I use ratios is on hedges. So I'll do it on, SPY puts, VIX calls. I'll
excuse me.
do a credit spread on SPY to buy like UVIXI, things like that, where, if the market really sells off, I'm going to be in the money. But if the market rallies, if I'm, doing those premium neutral, I'm not losing any money. So I love doing stuff like that.
To me, this feels like we're going into a potential, let's start putting on some collars type of environment. And yeah, I kind of get the sense of that's what we're leading to. What are your thoughts on that?
Yeah, I would say I'm a little bit different. And I respect what you're talking about. The reason why I say that, once we break above that new all-time high and we sustain above that for, let's say, a week or so, you're still going to get a significant amount of cash on the sidelines from an institutional standpoint that's going to be putting dollars to work. I think if you look at value plays in the market or those that have been laggards, X small caps, because I just don't like the Russell. I'm just, if you want to.
Yeah.
Just so you know where we're coming from, I say over and over and over again, that is a crappy index.
Yeah.
It's a
IWM
trading vehicle. I would not say, hey, I'm buying IWM and holding it.
Right.
Yeah. But you could look at maybe some small cap. So I actually am a fan of like some small cap industrial, small cap industrial sectors and things of that nature. But from a technical standpoint, I kind of look at, testing an area of resistance. We tested it before, we failed, we come back, test it again, breakout, having additional dollars being put to work in the market. Around that same time, you're going to have rate cuts. No matter if it's July or February, or July or September, right. We're going to have rate cuts. So I feel actually that we actually look at a consolidation breakout and rerun before we stop. If you kind of go back and look at the last 20 years, 30 years of the S&P 500, and we had these bear markets, a lot of people, and I feel bad too, because sometimes if you didn't scalp below, then people think you're a scrub. And I'll use that as like the worst play. But, a lot of people feel that, oh man, I didn't get the lows, I'm too late. And it's like, no, go back, look at the S&P 500 chart, look at a NASDAQ 100 chart, and see what happens when you go back and retest those all-time highs. What happens next? Like, you're not late. Did you not get the lows? No, but you could actually still play the breakout, and the breakouts can be very aggressive. You're talking about 25 to up to even 70% gains to the upside before we have a new technical bear market on these setups. So I think we actually are basing a breakout. And full disclosure, guys, this is the most bullish that I've sounded for a long time. I'm actually not that bullish.
Same.
Ever. I'm never that bullish. I'm always like the guy that's like looking over my shoulder. Like, for me, the only other thing that's holding me up from just being full on this market's going to rip is credit default swaps are still actually moving to the upside. And that's the only thing that's the big question mark, because credit default swap pricing leads equity vol. And so equity vol is crushing, but credit default swap pricing is actually still elevated. So there's a disconnect there that doesn't usually last that long.
Can I get one question in, please? You talk about small cap industrial sectors. Like, what would those be? And like what names, any names in those sectors?
And so actually, if you look at what I've been actually looking at is this faux ETF, and you guys can look at it.
Which is it?
Faux, PHO, like if you're eating faux. It's an Invesco water
Ah,
ETF.
Water.
It's not sexy. I like
Good point, though.
I like looking at sectors that are underperforming, that might be undervalued, that actually have relatively cheap options on them, and they are trading a little bit disconnected from their valuation that I feel like they're valued at, or the market's underpriced in the theme. So when you're looking at small caps, or even if you're looking at industrials as a whole, I kind of bring this one up. This is more of utility / industrial play.
Right.
But we always have this, thought of, okay, we have AI, artificial intelligence, you have onshoring that's taking place right now. You also do have war that has been priced in. Things that have been expelled over the last 2 weeks, 3 weeks will need to also get backfilled. So you're looking at metals companies that actually are going to be participating in that. But I'm looking at water utilities right now. It's not sexy at all, but it's actually had a hell of a run yesterday. And the reason why I'm kind of looking at that, drought conditions in certain respects here in the United States, you also need water cooling and water infrastructure for these small modular nuclear reactors. So people are kind of like forgetting that portion of the overall sale. And you don't actually have major, like very large water equipment providers that are out there. They're usually on a little bit more of a smaller scale. And then you have the utility providers. So I feel like there's still a catch-up trade here where this actually could break out. You can even look at some of the individual companies within that index. So I actually like those plays for right now. I am a little bit optimistic around the copper demand here in the United States.
Copper. I was going to ask you about that one.
In China as well. So that's something that I wrote about earlier this year. And then I'm still a proponent of liquefied natural gas. I think that's going to be the big winner with these trade deals that are going to be announced over the next couple of weeks as well. So
I was looking at PHO and comparing it to TNA.
Yeah.
TNA is one of my like big time income positions that I like to mess with, and it's starting to swing up. We're leaning on potentially, cutting rates, so that's where I'm at. I'm a little bit bullish on it, at least for a reversion to like $40. But as for your small cap rotation, it's almost like completely dependent on whether or not we're going to drop those rates or not. So projection wise, I would say we're pretty much on course for a rate cut. But what are your thoughts in the fallout in the Fed that might correspond otherwise?
Yeah, I don't like. I don't really like. If your trade depends on the Fed cutting, then that you shouldn't be trading. That's how I kind of look at it. That's just me personally. I like looking at stuff that I know have secular trends. So, but there could be a play there, like TLT.
Yeah. I was going to ask about the bonds next, actually.
I mean, that's actually a pretty decent play. I kind of go back though. If you're kind of looking at the industrial sector, if we are in late cycle, starting in early cycle, industrial should actually outperform here in the next 6 months to 12 months. And if you look at the industrial sector as a whole, it's actually the first one that made a new all-time high out of any of the sectors, out of communication services, out of technology. Industrials were the one leading the way. And I think that that's actually going to continue. If you look under the hood, what's really been outperforming? Boeing. But if you kind of go back and you look at the UNPs of the world, Union Pacific, CSX, they're not really performing that great. But this week alone, we are seeing a 78% increase in total in volume at the LA ports. No one's talking about that anymore. 78% increase year over year. Now, obviously, there's a pull forward there, but you are actually starting to see it come back. Now, there's a small little drop off once you get to July 7th. But this massive uptick in volume is going to be a tailwind for these industrial companies. And I'm really kind of talking about locomotives. You can also look at road freight. So the JBHTs of the world, JB Hunts, be careful with that one. They have some internal issues here. But the other thing that I'm kind of focusing on, and I go back to the industrials, what just also happened? Diesel prices literally hit year-to-date highs. Diesel will stay elevated relative to other energy products like crude oil and gasoline, because there's a structural shortage in inventory for diesel. With these companies like Union Pacific, CSX, guess where they make a boatload of their money? Surcharges on fuel. It's not actually moving freight. they actually have the margins that they make is actually charging their customers more money than what diesel prices are right now. So we had this relative spike. You're going to see that to the upside. Diesel's still going to come down. I think there's going to be a margin there. I think you're going to see a little bit more of and a little bit more of an improvement. You have the budgetary bill that's going to be going through, potentially going to get approved here. If they want Dems on board, I would not be surprised, guys, if you do see in the next 6 months an infrastructure type of bill being passed out there, especially if you're looking at rural infrastructure. So I actually like the industrial plays, and the industrial small caps have the least amount of exposure to tariffs and the least amount of exposure when it comes to dollar risk. So
the infrastructure thing you mentioned is really interesting. So we're big into thematic.
Yeah.
And, and the biggest theme right now in my mind is Trump. And, part of that is trying to anticipate his executive orders. So, we called his drone executive order, for example. We called his nuclear executive order. If he's stewing about an executive order for infrastructure, that's something that could be really interesting as well.
Yeah. I do have to jet two things. I don't think solar is out of the question.
Interesting. Okay.
So look at solar. If you look at the FSLR calls going out, I think about a month or 2 months.
Yeah, I saw that.
Relatively cheap for the pricing. You could probably pull out some diagonals or some calendars there, depending on what your flavor is. But just be mindful. They need Iowa. You need that support in Indiana. And no matter how much they hate renewable energy and wind, especially, and solar, but wind, those farmers, almost every single darn farmer out in Iowa, every single darn farmer out in Illinois, I'm from Illinois, every single one of those guys, the big names out there in Indiana, you just drive down, 80 or whatever, they all have those installations on their farms because they're basically REITs for those power companies. I don't think that's a foregone conclusion. I don't think it gets past the Senate that they actually remove that, or at least it gets past the Senate as they remove that, because that's going to be a very sticky election issue, even in rural counties. So
interesting. Cool.
Appreciate you guys having me on.
Thank you.
Thanks for coming.
Yeah, thanks for coming. We'll have you back.
Appreciate you.
All right, see you later. So we're signing off, guys. Matt, let's just do one thing before we go.
Sure.
You didn't really. He talked about UNP and CSX. You don't like the rails, or it's something you didn't really want to talk about?
I mean, he was just throwing out symbols.
Oh.
Yeah.
Yeah. I mean, I don't mind this chart compared to, again, I'm more of a counter trend guy.
Right.
So, I feel more comfortable buying something that's not at all-time highs. I just need there to be something thematic, behind it.
Right.
So, I wouldn't just say, all right, I'm going to buy, UMP, because I don't know where that theme is. And I think there are other things that buy.
Okay.
That, and then the solar thing actually kind of caught my interest there. If you look at the weekly chart on FSLR, it's a little more interesting than the daily.
The daily's immense.
Yeah. But the weekly there, you've got the makings of the second low and the double bottom. If it holds support there, it's got potential for a nice little reversion trade. And then it kind of put this other thought in my head. There was mention of the beaming solar energy from space thing, how far out that might be. It's actually looking a little closer than we thought. So I wonder if you combine the two. If you look at basically the space mirror idea. So
I'd have to get a lot better understanding of that. I don't know whether these companies would be the beneficiaries or not, but they may be.
Right.
I mean, that'd be a ChatGPT thing, because obviously I have no expertise in that. But
all right. So where are you at with Oklo? OKLO these days? Is that still? I haven't watched any of that. It's sold off some.
About Oklo tomorrow in the newsletter.
Well, it's sold off a little bit.
Yeah, well, I mean,
the general pullback.
15 from a high of 73 to a low of, I mean, it sold off 20 points.
Well, if you would have bought it at 20 when you first recommended it in April, then, you know.
Right. No, I mean, anyone who's been trailing us on Oklahom's made a fortune.
Yeah.
I actually, I mean, I like it right here. Undercut and rally of the 20-day EMA. This wouldn't be a bad spot. I hate buying something.
How about like ASTS? You still there? Can you pull that one up?
Yeah, I mean, I own ASTS. I think. Don't I own ASTS?
A lot of white graphs there, Jeremy. A lot of white. What do you call those
Yeah,
things? Bars?
I mean,
what do you call those things?
yeah.
That's good, right?
That's a lot of bullish bars. Yeah.
Yeah.
Yeah, I mean, the problem is, you know, again, the way I look at the world, I'd be looking to take
From profit.
profits.
Yeah, it's a bit parabolic.
Yeah.
All right. You know, I always say you never go broke taking a profit, right? All right.
Right.
So what's RKLB? How about that bad boy?
That's one I've been watching too. RKLB is
You in that one? You're in that one, Matt? Market Lab?
I'm in that one too. Yeah.
I
All right,
have
let's
like
look at that one.
a foot. I like it's called a foot position. So like whenever I've exited a position to take profit on something that went parabolic, you know, I got the right entry, whatever. I always leave a few shares on, and this is one of them with Rocket Lab and a few others. This chart is pretty damn bullish still. It's got another left into it, pretty close to $38 with a target. So I'm still on board.
Well, I mean, I'm just the kind of the bystander on these combos, but like I gotta say, you guys have been on these names, so congrats on that.
Which is why, like I said, I like thematic stuff. You know why Rocket Lab and ASTS and Oklo and all those things are moving versus like, I mean, I love the chart of JB Hunt.
Yeah.
But I mean, why would this go back?
Well, let me ask you a question. What if Trump came out tomorrow and said, I'm going to give tax breaks to all the trucking companies and rail companies and all the transport companies? Then you're in.
Then I'm in.
Right.
Right.
I mean, the chart's just sitting there. It's consolidated. It's just waiting for a catalyst to break out. And if it gets that catalyst, yeah, that'd be a great theme to be into. And, you know, like Kevin was saying, that they make most of their money on fuel surcharges because that gets paid for by the clients that they're shipping for. So, you know, it doesn't matter if fuel prices go up. Those fuel surcharges will go up, but they have a fixed percentage. So, you know, just as the base value of fuel goes up, that percentage doesn't change. So it's still going to be, you know, a 3% surcharge or whatever it may be. And instead of being a 3% surcharge of like $3 a gallon fuel, it'll be of $4 or $5 a gallon fuel. You know, you get more margin that way. So beneficially, if you start seeing traffic pick up at the ports, like he was saying, that's going to be a theme to watch. And then if Trump steps in and says, hey, I'm going to cut taxes to all these guys, absolutely, that's going to be a killer theme.
All right. Okay. We good?
We're good. I'm good.
We are good.
I'm happy. I'm taking profit and having a good day. So,
all right, everyone. Have a good day. Thanks, Matt.
Right.
Thank you.
Have a great one. We'll see you guys.